Over the last weeks, markets became quite concerned about France. The OAT Bund spread temporarily soared above 80 basis points, the highest since 2012, when a euro breakup was considered a realistic scenario by markets. The big concern is the forthcoming presidential election. The far-right candidate Le Pen explicitly wants to hold a referendum on EU membership. In polls, she gets about 1/4 of the votes. As of late, rising support to the extreme left candidates and speculations about a cooperation among them scared markets. They fear a scenario in which only extremist candidates enter the second round of elections. However, even if an extremist candidate like Le Pen were to become president, the hurdles for an EU referendum would still be extremely high. A parliamentary majority in the general elections would also need to be achieved. A referendum would need to be won in a country where the majority of people still views the euro as a good thing. Polls consistently hit at an ultimate victory of a center candidate. As it stands now, the reform-oriented candidate Macron will make it. Such an outcome would not only calm financial markets, but also raise the long-term economic prospect of France. Against this base case, the current OAT Bund spread looks high. With the euro area February composite PMI having climbed to the highest level since April 2011, sentiment has reached a territory historically consistent with key rate hikes. So, will the ECB turn hawkish now? We doubt this for the following reasons. First, the ECB will look through the temporary inflation spike and focus on core inflation. In the past, the key rate moved in lockstep with core inflation. The January reading of 0.9% year-on-year is still way below the ECB's norm of price stability, and the future rise in underlying inflation will be muted in our view. Second, the ECB will also be aware of the downside risks to activity, especially the risks emanating from higher protectionism in the US and political uncertainty in the euro area. Third, the ECB emphasized and reiterated several times that the recovery was still dependent on substantial support from the ECB. This implies that an unwinding of the policy stimulus would be premature. Therefore, we expect the ECB to hold a steady course and to communicate this also at the next meeting on March 9. That said, if none of the macro risks materializes, we continue to look for the start of the tapering discussion in the second half of the year. At present, financial markets remain caught between continued strong economic data and rising political uncertainties in Europe and in the US. We expect the political risks not to materialize over the coming weeks. Therefore, we recommend to stick to an underweight in core government bonds. In the US, strong macro data and the willingness of the Fed to raise its key rate will set the tone and likely lift Treasury yields in the weeks to come. The nearing French presidential elections, other euro area-related political uncertainties, and continued ECB bond buying will dampen yields for the time being. However, as we expect the recovery to proceed and some uncertainties to unwind in the coming months, we also see bond yields rising moderately. In this environment, high-quality euro area corporate bonds look attractive to us. Sound fundamentals and ongoing support from the ECB asset purchases induce us to overweight this asset class. Also, albeit to a lesser extent, European equities look favorable. From a valuation perspective, they still look cheap and the earnings outlook is encouraging. For the US, we are more cautious. Equities appear expensive from a valuation perspective, The market has priced a very optimistic view on the Trump policy measures, and unit labor costs are expected to rise. Thanks for listening. We'll keep you updated.